BlackRock manages more money than the GDP of most countries, over $10 trillion. That's more than the entire economies of Germany, Japan, or the United Kingdom. But here's the part most people don't understand. BlackRock doesn't actually own that money. So how does one company control more wealth than entire nations, like without being a bank? To understand that, we need to go back to the beginning. BlackRock was founded in 1988 by a former banker named Larry Fink. After a bad experience managing bond investments at his previous firm, Fink had one obsession: risk management. He believed most financial disasters happen because firms don't properly understand risk. So he built a company designed around one principle: measure risk better than anyone else. At first, BlackRock was small. It focused on managing fixed income assets. But over time, something changed. Institutions began trusting them: pension funds, insurance companies, governments. And trust is everything in finance. Because when someone trusts you with their money, they pay you to manage it. That's the key to BlackRock's entire business model. They are an asset manager. They don't take deposits like a bank. They don't gamble like a hedge fund. They manage other people's money, and for a fee, usually between 0.1% and 1% per year. That sounds tiny. But when you're managing trillions, tiny percentages turn into massive revenue. Let's break it down. Imagine BlackRock manages $5 trillion and charges just 0.2% annually. That's $10 billion per year in recurring revenue. No factories, no physical products, no inventory, just fees. And here's what makes it powerful. As long as investors keep their money invested, BlackRock keeps earning, whether markets go up or down, because the fee is based on assets under management, not performance alone. But that's only one side of the story. BlackRock also owns one of the largest ETF brands in the world. It's called iShares. ETFs, or exchange-traded funds, are investment funds that trade on the stock market. Instead of picking individual stocks, investors buy a basket of companies. It's simple, it's cheap, and it's exploded in popularity. When millions of people invest in iShares ETFs, BlackRock earns a small management fee on each dollar invested. Individually, those fees are small, but collectively they generate billions. Passive investing has grown rapidly over the last decade, and BlackRock sits right at the center of that shift. The more money flows into passive funds, the more assets they manage, and the more revenue they collect. But now we get to the most interesting part of the company. BlackRock built a powerful software platform called Aladdin. Aladdin stands for Asset, Liability, Debt and Derivative Investment Network. It analyzes global markets, risk exposure, and portfolio performance. Banks use it. Institutional investors use it. Central banks use it. They pay subscription-style fees to access it. So BlackRock isn't just managing money. It's analyzing the financial system itself. That gives them enormous insight into global markets. It also creates another revenue stream: recurring software income. Now here's where people start to raise eyebrows. Because when you manage trillions of dollars, you hold shares in thousands of companies. Apple, Microsoft, major banks, energy companies. BlackRock doesn't own those companies outright, but they hold significant stakes on behalf of clients. And when you hold shares, you get voting rights. That means they can influence corporate governance, board decisions, executive compensation, strategic direction. They don't run the companies directly, but they sit in the room, and that influence is powerful. This is why some critics argue that asset managers like BlackRock have become too powerful. Others defend them, saying they simply represent investors. Regardless of the debate, the model is brilliant. BlackRock earns money from management fees, ETF fees, software subscriptions, advisory services, and because their revenue is tied to total assets under management, as global wealth grows, they grow with it. But no company is invincible. BlackRock's biggest risk is a major prolonged market crash. They also face political scrutiny. Regulators watch large asset managers closely, and public perception matters. Still, the company has survived multiple financial crises, from the 2008 crash to global recessions to market volatility, because their business model is not about betting on markets. It's about sitting in the middle of them. BlackRock doesn't need to predict the future perfectly. They just need investors to keep participating. And as long as people invest for retirement, as long as institutions manage pensions, as long as governments allocate capital, BlackRock will likely remain at the center of it all. They don't own the world, they manage it. And in modern finance, that might be even more powerful. If you want to understand how money really moves at the highest levels, don't just follow the billionaires, follow the managers. Because sometimes, the people managing the money have more influence than the people who earned it.